Right now, something very unusual is happening in the gold market, and most people are completely misunderstanding it. Gold has dropped more than 17% in just 3 weeks, and over 10% in a single week. That kind of move is extremely rare. In fact, we haven't seen a weekly drop like this in decades. So naturally, the big question is the gold bull run over? Or is this actually something bigger happening behind the scenes? Welcome to Gold_Scope, where we break down gold and silver in the simplest way possible so you can understand what's really going on and make smarter decisions. Now, let's start from the real root of this situation, energy. Because in global markets, everything starts with energy. And right now, the oil market is showing something very strange. We are seeing massive differences in oil prices across regions. Asia is trading at much higher levels, Brent is somewhere else, and the US market is even lower. Normally, these markets move closely together, but right now they are completely disconnected. This kind of divergence is a warning sign. It tells us that something deeper is breaking inside the global financial system. Now, if you think about it logically, rising oil prices should actually push gold higher. Why? Because mining gold becomes more expensive when energy costs rise. At the same time, we have war and geopolitical tension, which usually increases demand for gold as a safe haven. So everything seems bullish for gold, right? But here's the important part that most people miss. In the short term, markets don't always behave logically. Instead of gold going up, we are seeing it fall sharply. And to understand why, we need to zoom out and look at history. When we look at gold's past, this recent drop is one of the worst weekly declines in nearly half a century. The last time gold saw a similar drop was around 1980. That's a huge deal. But instead of panicking, smart investors ask a better question. What happened after these big drops? So when we study the worst weeks in gold's history, something very interesting appears. Many of the biggest crashes didn't happen at the end of a bull market. In fact, several of them happened during strong long-term uptrends. For example, during the 1970s bull market, gold experienced multiple sharp weekly declines. But each time, the price recovered within months and continued moving higher. This tells us something very important. A big drop does not automatically mean the trend is over. In many cases, it's just a temporary correction inside a much bigger move. And that's exactly why understanding context is everything in gold investing. If you only look at 1 week, you might panic. But if you look at the bigger picture, you start to see patterns. So the real question is not just why did gold fall, but rather, what kind of market are we actually in right now? Because once you understand that, everything starts to make sense. Now let's go deeper, because this is where most people completely misread the situation. When we continue looking at history, we find the remaining worst weeks in gold happened during very specific global events. For example, during the 2008 financial crisis, during the COVID crash, and now during the current geopolitical tensions. And every single time, we see a similar pattern. Gold drops sharply, then recovers, and then continues its long-term trend. This is extremely important to understand, because it tells us that these sudden crashes are not always a sign of weakness. Sometimes, they are a sign of stress in the system. And that brings us to the key concept behind what's happening right now, liquidity. This is not about gold being wrong. This is about liquidity breaking in the financial system. Let's simplify this. When markets are under extreme stress, big institutions don't sell what they want to sell. They sell what they can sell. And gold is one of the easiest assets to sell quickly because it's highly liquid. At the same time, oil prices are rising sharply. This creates pressure across commodity markets. Funds and institutions start facing margin calls. They need cash immediately. So what do? They sell gold. Not because they don't believe in it, but because they need liquidity. And this creates a strange situation where everything starts falling together. Stocks go down, crypto goes down, and even gold goes down while oil moves higher. This is not a normal market. This is what we call forced deleveraging. We saw the same thing during COVID. In the beginning, gold also dropped. But once the panic selling stopped, gold quickly recovered and continued higher. So the real signal is not the drop itself. The real signal is what happens after the selling pressure ends. And history shows us that once this forced selling phase is over, gold usually starts repricing higher. That's why experienced investors don't panic during these moments. Instead, they try to understand the phase of the market. Now let's connect this to the current situation. We have war, rising energy prices, and global uncertainty. Fundamentally, all of this is bullish for gold in the long term. But in the short term, liquidity stress is dominating the market. So both things can be true at the same time. Gold can be bearish in the short term and bullish in the long term. And this is exactly where most people get confused. They expect gold to behave the same way in every situation. But markets don't work like that. Different time frames give different signals. And if you don't understand your time frame, you will always feel lost in the market. So now the most important question is, what should you actually do? The answer depends on one simple thing, your time horizon. If you are thinking in terms of days, then the signal is already clear. In short-term trading, gold is under pressure. Liquidity is tight, and there are stronger opportunities in other areas like energy markets. In that case, many short-term traders move out of gold and look for faster-moving opportunities. But if you are thinking in terms of years, then the situation looks completely different. From a long-term perspective, nothing has really changed. In fact, history suggests that these kinds of sharp drops often create opportunities. If you look at every major crash in gold, long-term holders were usually rewarded. The trend continued, and prices moved higher over time. So for long-term investors, this kind of drop can actually look like a discount, a quality asset temporarily on sale. Now there is a third category of investors, those who think in terms of months. And honestly, this is the hardest position to be in, because predicting what will happen in the next 2 to 6 months is extremely difficult. No one could have predicted this exact combination of war, oil shock, and market stress. That's why this middle zone is full of uncertainty. In most cases, the best approach here is patience. Instead of reacting to every headline, it's better to stay focused and avoid emotional decisions, because markets can recover faster than most people expect. So when you look at the full picture, this situation is not as scary as it looks. It's not necessarily the end of the bull market. It's more likely a phase, a temporary shock, before the next move. And the biggest mistake you can make right now is reacting without understanding. If you found this breakdown helpful, make sure to subscribe to goldsilver_scope for simple and powerful insights on gold and silver so you can stay ahead of the market.